M2 is going to continue to fall. This is a massive experiment by the Federal Reserve. I don't even know what the ramifications are. Absolutely, we have no idea what's going to happen. The Fed does, nobody does. But in my mind, it ain't good. The measure of inversion is conviction. This is the bond market's conviction that we're going to be right and you're going to have to lower rates and you're going to have to lower them significantly. It's just the bond market going, it's not going to work. You're going to create a recession and you're going to be forced to cut. End of story.
Welcome back to the Bitcoin Layer. Today we are joined by a very special guest, one that I'm extremely excited to have on the show, Mr. Randy Woodward. He is a fixed income bond broker at Raymond James Financial. Randy, welcome to the show.
Thanks for having me. Looking forward to it.
Absolutely. For sure. Likewise. This is a conversation I've been looking forward to for quite some time. Followed you on Twitter for a very long time, the self-avowed bond freak. That is your Twitter handle. You're certainly one of the best places to go for all of the fixed income knowledge. So going to have a wide-ranging discussion today, hopefully touching on a lot of that. I want to kick things off with liquidity. We'll talk about liquidity conditions and then dive a little bit into what the Fed is doing, how it's impacting credit and debt markets more broadly. Specifically other deposit liabilities. This is a metric that your Twitter initially put me onto as a better measure for global liquidity. So why don't you talk to the viewers right now about what other deposit liabilities are and basically how it plays into the current situation with money supply?
Well, ODL is something I didn't even know about it till Lacey Hunt came out from Hoisington Management. He brought it up maybe 6 months ago, maybe a little longer. And I'm fortunate to know Lacey fairly well. And so, I've called him several times on it and we followed it together. And basically what he says, it's the most spendable money. He said, I think the total deposits of banks is north of 17 trillion. But he says not all of that is necessarily spendable money. And so what he did is he started following ODL as something that is more in line with spendable money, spendable cash. And of course, that's going to have an impact on inflation. So he feels that's a better measurement and probably a more a leading indicator of inflation or disinflation or deflation than other measures.
We're going to take a quick break to talk to you about this show's sponsor, River Financial. I love buying Bitcoin, and River is my favorite place to buy it. They have zero fees when you dollar cost average, and they have their own proprietary multi-sig setup, so you know that your Bitcoin is held with them and not lent out to any other custodians. You guys, River is setting a new standard in Bitcoin. You can invest today by going to river.com or by clicking the link in the video description for a special offer. And now back to the show. Got it. Okay. Spendable money. That's a tremendous way to put it. From the standpoint of a lot of what we're talking about right now is how quickly the Fed is removing money supply from the system, but having the best proxy for money supply really helps when sort of making that argument. I'm pulling up a chart right now for the viewers, and it's a chart that I sent to you a little bit earlier. And this is a chart of other deposit liabilities. And you could see it's come down pretty substantially from its peak here, 16.7 trillion, something like that, I believe, basically. And it peaked right around when the Fed began its interest rate hikes. And now it's fallen to 15.25 trillion. So pretty big fall in spendable money. What are the implications here for price inflation?
Well, it's complicated because you've got QT, which it seems debatable about really, how QE adds money to the system, how QT takes money from the system. Some say it has no impact, some say it does. But the fact remains that M2 is coming down, and I think you're going to show that here in a minute. And that's, there's no other way to put it. Money is being destroyed. And that can be done can be created and destroyed in several different ways. I do believe the Fed with QT is destroying money. And then as banks cease to lend, now, again, this is a rate of change. They're not going to just stop lending, but as they slow down and most of my clients, and I guess this is a good opportunity maybe to explain really quickly what I do more specifically is, so I started at Bloomberg in 1988. That's how I got into this whole world. And most of what I've done my entire career is deal with banks and credit unions for the most part. In 95, I left Bloomberg to become a bond broker. So what I do is I sell bonds to banks all across the country. So I know exactly what their portfolios look like. I know exactly what they're experiencing. I'm talking to them every single day. And this is kind of what I've been trying to relay on Twitter. And we're going to get more into it as we go, is also trying to tell people where they've been so wrong. Financial media has been so wrong in so many ways about what's going on with banks. But the fact is, deposits are coming down. And there's this argument that banks can create deposits, so they don't really need deposits to create loans. That's ridiculous. Yes, on the whole, over time, that is the case. That is, if a bank makes a loan, they create deposits, but that doesn't necessarily mean it flows right to them. So if their deposits are coming down, they're having to lend less. In a lot of cases, I would actually say most cases of my clients, they're shrinking. And so that's going to be less credit availability, less money to spend. And you got to figure, and again, Lacey said, and he was so right, ODL, because it's a fairly quickly uh, updated number, is going to lead M2 lower. And it's exactly what's been happening. So this just all to me, if you're a monetarist and if you follow, Irving Fisher and Friedman and whatnot, if you cut the supply of money, that's deflation. And
Mhm.
I believe ultimately that's where we're headed. And this is one of the numbers that I think proves that.
One of the slew of numbers that I think
Yeah.
proves that it's been something on the mind of many people, and now that we've returned to from 9.1% consumer price inflation all the way down to 2.97, rounded up to
hmm
3. A lot of people are finally coming around to the reality that, whoa, it's 12 months straight. Maybe the risks are posed to the downside here.
Well, and
So,
that's why they keep moving the goalposts, by the way, right? So
mm,
the Fed's changed what it wants to consider inflation twice now, two big changes. So, this is why they go to PCE, core. We want to take food and energy out of there. And then recently they went to super core, right? Because we want to take out housing too. Because look, I think it's a really important thing. When the Fed is ready to cut rates or even pause or whatever, they want to control the narrative. They want to control uh, what they're going to do and what they expect the market to do. They don't want the market getting ahead of them. So that's why they keep changing and moving and trying to divert attention. Fact is, CPI has come down dramatically. It's a lagging effect. And my opinion is I think the Fed might lose control. And, this is why Powell's very, very, very careful when somebody hit two or three times in his press conferences, someone has said, your efforts to bring down prices. He immediately jumps out of his skin, says, no, 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 no. I'm trying to bring down the rate of change. I want to bring it to disinflation. I want less inflation. He does not want to bring prices down because that's deflation, and that's a whole nother story, another topic. But that deflation can get way more out of hand than inflation, and that scares the hell out of them. So these little mnemonics of thought that he proposes in changing the narrative on CPI and what their target is, very purposeful because he doesn't want to lose control.
absolutely, very deliberate, and that's something we've talked
hmm
about on the show in the past too. Has been managing expectations, extremely important in the market, and that's sort of what Powell's trying to do. He's trying to rein in the idea that the Fed's trying to bring down prices, but rather bring the rate of change
That's
back down to
correct.
its
That's right.
its long run
And
average,
most
because
people
the
get
Fed.
that wrong. Most people don't understand that. My parents
Hmm.
don't understand that. My friends who aren't in the business don't understand that. They say, "Well, I can't wait for food price to come down. I can't wait for rent to come back down." Da, da. Well, don't count on that because that's not the Fed's goal. The Fed's goal is just to bring the rate of change down.
Absolutely, inflation has almost become people conflate it with prices. When they think inflation, they think prices. Definitely a
Right.
colloquialism that needs to be adjusted. So
That's right.
one chart I wanna ask you about here. You talk about how many will argue that it doesn't matter if banks have deposits; they're still going to write loans. But in the long run, it does matter. You see that lending and actual deposits and the amount of lending that commercial banks do, moves in lockstep with one another. And I have a few stats, and then I'll ask you about a chart for U.S. consumer loans. It's that deposits at U.S. commercial banks fell $108.5 billion this week, and that's combining, or last week rather, excuse me, and that's combining small institutions and large institutions. And then by the same token, you've seen rather over the past several months lending from U.S. commercial banks flatlining. And if we take a look at this chart here, which is U.S. commercial loans, you've seen now over the last 3 to 4 weeks massive decline in consumer lending. That's finally beginning to, the cycle has now shifted from rising consumer loans on net to now it's falling, which historically, if you take a look back before 2008, even in the 2019 area during the Fed's last hiking cycle, this has historically preceded economic recessions. What are your thoughts here as you look at this chart?
So you said an important word a few seconds ago, is flatlining. So that's precisely what I'm talking about as far as inflation, disinflation, deflation. If when the bank makes, when they're making loans, they are creating money. Okay. If they stop making, let me say that again. If they stop growing their level of lending, that means they're flatlining and money is going to flatline. Okay. Then we'd have zero inflation. Okay. I mean, it's never going to work out perfectly. But if they start pulling back on lending, now we have less money creation. And that also means that they're probably going to shrink their balance sheets a little bit. And that is deflation. Okay. And somebody's got to make up for that. I don't know. It could be the Fed, could be more stimulus checks, who knows? But unless something changes, again, I point to the fact I really think we're going to see deflation in probably the next, 6 to 12 months. I wouldn't be surprised if CPI goes negative.
Wouldn't be surprised indeed. There's one last chart regarding the disinflation slash deflation story that I want to pull up, and it's rather disconcerting. Of course,
Hmm.
we know per you that ODL is a better measure of money supply because it's spendable money. But the traditional measure is M2, and if you lay M2 and CPI inflation over the top of one another, and
Right.
you lag CPI by 12 to 18 months, then you kind of see this is corroborating the idea that you and I share that you just mentioned, that the risk now is that CPI growth actually contracts, it goes negative. We get
Yeah.
into deflation.
Right. So M2 here, year over year's changed now. M2 is still super important, incredibly important to watch. And I think what Lacey's saying is ODL is just going to get ahead, way ahead of M2, and it did. I think it was like 6 to 9 months. It started going negative before M2 started going negative. So it's a great leading indicator. But here's what your viewers need to really look at here is we're negative M2, right? We're minus 3.9% year over year. We've not done that. Maybe one little blip like in the 50s or maybe the 70s. We might have gone like just one quarter with the negative M2. Not since I think 32 maybe, which of course
Mhm.
was all hell and fire damnation with the Great Depression. Have we done this? So the Fed, my opinion, they have no idea what the hell this is going to lead to. I mean, this is extraordinary. And we're not done. ODL just fell last week, another 102 billion or something like that. It's still falling. M2 is going to continue to fall. This is a massive experiment by the Federal Reserve. And I don't even know what the ramifications are. But when I look at that, this graph against CPI, how does CPI not go negative? That's that's going to be the big trick here. And that's when I think things get really scary for the Fed, is if we start to dip below, even start to fall below 2%, it's going to get people's attention. If we start to fall below zero, it's going to be like, oh my God, we gotta do something here really fast.
Absolutely. Hell in a handcart,
Yeah.
14 years of rates locked at zero, followed by, I think this is since the 90s, the most consecutive 75 basis point rate hike increments,
It's
5 in a row,
ever.
6 in a row.
It's ever. Yeah, it's the fastest.
My
Listen,
goodness.
even, people are refer like, oh, Volcker did this, did that to this. Well, we didn't have 15 years of zero before Volcker, and then
Hmm.
blast it faster than anybody raising rates, any Fed chairman ever in history. This again is a grand experiment. We don't really know the lag. We don't know what's going to happen. This is why, I've been very critical of the Fed the whole time, because they're it was so much so fast. I wish they would have gone slower. I wish they would have paused earlier to be like the adult in the room and explain, look, there are going to be transitory prices in here, price changes in here. We don't know exactly how that's all going to work out, but we need to take our time and let things happen. But I don't know, maybe politically they got pressured to have to kill inflation as fast as possible.
Hmm. One grand
But this is
experiment,
extraordinary. That
indeed.
that
Yeah.
minus 3.9 is just, it doesn't seem extraordinary, but you got to go back to 1930 and you'll see it has never happened. Okay, so what an unbelievable experiment we're getting ready to face here.
It's particularly disconcerting. You never want to hear the sentence, this is the first time X has happened since the Great Depression. You never want to hear that kind of sentence.
Well, we
It's
hear
usually
we
not a
hear
good thing.
that since the great financial crisis all day long,
Hmm.
right? That gets my attention. There was one we'll talk about if we have time. The Cleveland Fed just put something out. But yeah, if it's since the depression, that's a whole different ballgame. That's a absolutely, we have no idea what's going to happen here. The Fed does,
Hmm.
nobody does. But in my mind, it ain't good. It ain't good at all.
Absolutely. Nobody has any idea. You mentioned the Cleveland Fed report. When we'll talk about we can talk about other signs of deflation you're
Hmm.
seeing, outright deflation. The Cleveland Fed report put up a chart. I don't have it here, but I may
It's okay.
bring it up for the viewers. It is the Fed new tenant repeat rent index on a year over
Yep.
year percent change, and similar to this M2 chart that we just pulled up. You tweeted this out, and that is in deflation too. So that's pretty
Yep.
disconcerting. What other findings did that Cleveland Fed paper have?
So let me explain that. It's pretty fascinating. So the Cleveland Fed had been monitoring for many, many years. I don't know how many it was, but a long, long time. They've been monitoring rent, because rent, owner's equivalent rent is what the Fed, what they measure into CPI. It's about 30%. It's the biggest input into CPI. Well, what they came up with somewhere, I think in 2005, I'm actually looking at it now. They said, you know what? We're looking at all tenant rents. And that takes time, because if you and I have a lease and we get to a point where we feel like it's too high, we're gonna say, hey, look, I'm out. We're gonna move out. We're gonna go somewhere where the rent is cheaper, right? But that takes time. We have a lease that goes 6 months, a year, 2 years, whatever, right? So they said, what we're going to do, we're going to start monitoring new tenant rents. The new first guy loans, gets a rent. What's the new rents coming in at for similar properties and whatnot? And what their graph showed is it just went negative. And what they said is that metric of new rents is going to lead CPI, essentially, the owner's equivalent rent, anywhere from 9 to 12 months. And if you go back and look at that chart, it does. It absolutely leads. It leads the see Cleveland does. They monitor all tenant rents as well, and that's still pretty high. It's coming down pretty quick, but it's still like 7%. The new one just went negative to 0.19%, and it has not done that since '09, I think it was. Right. So
Mm.
that's an extraordinary thing. And if you look at the correlation is incredible to CPI. Again, that is a flashing red light to me that are you sure you're not putting deflation into the game here? And we'll see what happens. But it really struck me as a powerful number.
Absolutely, extremely powerful. And again, the amount of things we've been saying that this is the first since the Great Depression or the first since the Great Financial Crisis. It's disconcerting, and I think your phrasing of it all being one big experiment
Hmm.
is a great way to articulate the what appears to be the natural outcome of the last 15 years of experimental monetary policy. I think
Absolutely,
the
Joe. That's
introduction
exactly
of
right.
yeah, the introduction of mass quantitative easing and now
Hmm.
removing all that money from the system, it's fascinating.
They're going
And
to
the
find
yield
out they
curve,
can't do it. I think in the end, what they're going to discover is we cannot remove quantitative easing. We can't shrink the balance sheet. I think that it's the ramifications are going to be severe. And I've challenged some economists to this, and they just, when they talk about, well, what about, hey, M2's going down, deflation, and they're like, they'll just QE again. I'm like, oh, okay, great answer, excellent.
well, I believe it's a stated goal of Jerome Powell this cycle to never have to go back to 0% interest rate policy.
Hmm.
Um, are they trying to move into an era where they're less reliant on QE, less reliant on the zero lower bound? And do you think that that's viable? Do you think they can do that?
No, I don't. I think most, if you really go to the guys who've been doing this a really long time, they could, first off, Fed speak is what it is. It's no different than they got to say that. Yellen
Yeah.
has to come out and say, I don't see a recession in our future. There is nothing else she can say, because if she comes out and says, "Oh yeah, absolutely, we're going to have a recession, but we'll keep it mild," that could freak markets out. So they got to stay positive. Whoever the economic czar is for the administration has to say this is the best economy we've ever had. Doesn't matter if it's Republican, Democrat, anybody. That's what they have to say. So the Fed, a lot of what you see the Fed, they have to say these things to try to manage the outcome. Now, go ahead and introduce what you're showing, and then I'll continue.
Fantastic. Yes, all about managing expectations. So this is the 3-month, 10-year yield curve. The more popular yield curve to use and to monitor is the 2-year, 10-year yield curve. But this is the difference between the yield on the 3-month Treasury bill and the 10-month Treasury note, 10-year Treasury note, rather. Excuse me. And historically, the re-steepening of this curve precedes recessions. But more broad strokes, an inversion of this curve, meaning that front end rates are lower or higher than long end rates, means that people are discounting what may happen in the economy. This is a big signal of recession and a big signal of Fed policy error. So, what's your take on what the yield curve is doing right now?
Okay, so the word I like to use on this, when you're talking about inversion, which you have threes to 3 month, which is very much controlled by the Fed because they control the short end. That's Fed funds target rate.
Mhm.
They're going to take it up again this week, another 25 basis points. They can control the short end. They can't control the long end. And
Mhm.
we're using tens here, so a 10-year investment. So what this is saying is that I'm willing to invest in 10 years at 1.578% less than I am a 3-month T bill. Okay. That's not supposed to ever be the case. We're always supposed to have an upwardly sloping um, yield curve. Because when you invest in 10 years, you're taking on duration risk. You're stuck at that rate for 10 years, and rates could, go up, and you're going to miss out on that. So, you should be paid more for the longer end of the curve. What this is saying is that no, the bond market's like, no, I'm going to take less. I want to lock it in now because I know what you're doing. I know that you've risen rates, you're going to create a recession, and then you're going to have to lower rates again. So if I get, say, it doesn't matter if I get 6 months, a year and a half, 2 years, and I'm, I got my 10-year locked in. Well, what if I get this 3 month and all of a sudden rates are lower and then they go lower and then they go lower? So that's why they're willing to take less yield now, because they know their reinvestment rate is going to be significantly lower than it is today. And so that's when you get an inverted curve. And the measure of inversion is conviction. This is the bond market's conviction that we're going to be right. And the Fed, it's not that the Fed's going to be wrong. I think the Fed knows damn well what they're doing here. It's just that they know you're going to have to lower rates, and you're going to have to lower them significantly. And this happened to Greenspan, and he was asked about this in Congress, and he just said it's a conundrum, because they said, well, you keep raising rates, but the 10-year keeps going down. He's like, it's a conundrum. And really what it is, it's not a conundrum. It's just the bond market going, It's not going to work. You're going to create a recession, and you're going to be forced to cut. End of story.
Mm. And so they pile into the long end where when rates are inevitably cut, they have more upward potential for price appreciation
Right.
because
I
of that
mean,
higher
you go
duration.
with the 10-year today at, let's say it's right around 380, and most likely in a year it's going to be someone significantly lower that, and the short end's going to be even lower than that. It'll basically it's going to what do we call that, a bull flattener, where prices are going to go up, but they're going to go up more so on the short end. Those yields are going to come down, and then we'll have a normal curve again. But as you can see, you've got the red shaded areas here are all recessions. These inversions all just predict the recession to come, and that's how. And they've never been wrong.
They've never been wrong, indeed. So, if that's the case, the Fed is slated to hike another 25 bips in 2 days on Wednesday. We're recording this on Monday, and it's going to go live in a couple hours when we're done recording here. Our editor is marvelous. He's watching this right now. Very quick turnaround. So, with the Fed slated to hike, you know, policy rate expectation, 95% chance. So, that's not
Yep,
changing. They're definitely going
it's
to hike by
100.
another
It's 100.
25
It's
basis
effectively
points.
100. Yeah.
So if the yield curve is saying that they're wrong, and the Fed probably knows they're wrong per what you've said, then why are they hiking again?
I don't know. It's
Mhm.
it's. I think. Who the hell knows? I mean, probably to give them even more space to cut. Because, like you said earlier, I don't think Powell doesn't want to go back to zero bound. That's a
Mm,
handcuff, man, and it it that causes they got to go to QE. Cuts are it's forward guidance, and it's you go to zero, you lose your forward guidance on cutting rates, right?
mhm,
And it's what Bernanke said. 97% of policy is just words, right? It's not even actions, and he's 100% right. And he took it to a whole new level when he became the chairman. So why, I don't know, maybe to give themselves more room. It's going to continue to hurt banks because it just means more money is going to roll into money market funds. Banks are going
mm,
to, if they're going to keep those deposits, they're going to have to raise their deposit rates again, and all their, not all, but a significant uh, part of their balance sheet is stuck at low invested rates in loans and securities from the last 15 years, particularly 2021. It's just going to probably cause more problems for banks. I don't know why. I don't know why they're doing it. And what he's going to do Wednesday, my prediction is they have to raise rates because that's what the market expects, and
mhm,
that's what they've sold. He's going to probably sell another pause for the September meeting, and then probably say, data dependent, we go into November. I don't think he wants to raise again, but he wants to leave doubt so he can control it. Because, man, once he says we're done, then the market just shifts into cut mode. And I would say probably will invert even more. And because now we know, you got to have a full time permanent pause before you can cut. And that's
mm.
that's that's going to be the game over the next few months.
That seems to be the case. So with the price inflation battle basically won, right, and risk posing now
Hmm.
negative to the deflation side of things. Basically, the only enemy left on the battlefield, the way that I phrased it, is that the only enemy left on the battlefield, and it's not really an enemy, it's the financial institutions that are holding assets,
Yeah.
both loans and securities that have interest rate risk associated with them, both in the form of like defaults and devaluation, right, with things like U.S. Treasuries and other fixed income. So with that being the case, I want to get your take on a sentence that I saw earlier today on Twitter, and that is yield curve inversions don't predict recessions, they cause them. Meaning that, right, given banks borrow short and they lend long, when front end rates are this high and long end rates are this low, it raises borrowing costs relative to the cost that banks can lend at. So not only are they getting this huge deposit flight, unless they jack up their own rates, but they're now hemorrhaging money and putting themselves at risk. Do you lend any credence behind that statement? They cause recessions?
That's, I've actually never really heard anybody say that. And that's probably not too bad. There's so many moving parts. Does it
Mm,
cause it, in a vacuum? No. It's predicting it. I would say more so it
mm,
predicts. My banks, even with this inverted curve, any new loans are not going to be below what they're paying for deposits. End of story.
mhm,
Okay. But that's new loans. all the assets that are stuck, that's a different story though, because that it doesn't really matter if the curve's inverted. It it kind of does. That's interesting because it's hard for my clients right now that, hey, you're paying 5.25 for deposits, and what do you got in treasuries? Well, nothing. Everything's below that. So, the only place they can go to is lending, and lending's slowing down, and so yeah, maybe so. Maybe this inversion is let's say it's contributing to a recession. I think that's a good way to put it.
We're going to take a quick break to talk about Passport. This is a device by Foundation Devices, Bitcoin hardware wallet that you already know how to use. It has a gorgeous design and a very sleek and familiar interface, so you'll know how to use it the moment that you take it out of the box. If you've been on the fence about taking your Bitcoin off exchanges, this is the hardware wallet for you. Several exchanges that offer Bitcoin have turned out to be totally bankrupt over the last year, and if you leave your Bitcoin on exchanges, you're leaving yourself open to your Bitcoin being completely gone. With Passport, it takes just a few minutes to set up and experience the peace of mind that comes with taking your Bitcoin off exchanges and into your own hands. Take responsibility today. Go to foundationdevices.com and use code BitcoinLayer for $10 off your Passport, or just click the link in the video description. Now, on with the show. Contributing, phenomenal. I love it. All right, so one thing I wanna move into here as we talk about banks. We're gonna chat a little bit more about banks. If we look at this chart here, which is the total amount of emergency Fed lending, we'll note that it's fallen off somewhat in the primary facilities, like in the white. That's the discount window, the Fed's main lending facility, and also other credit extensions. That has steadily declined over the last several weeks. And the Bank Term Funding Program, which is the newest Band-Aid acronym created by the Federal Reserve, has also stabilized a little bit. So talk to us about the state of banks, right? Where are they at right now in terms of the need for emergency loans? And is this patchwork, or is this a lasting, has this thus far been a lasting engineering solution by the Fed that could stem the pain a little bit here and potentially soften the blow of any upcoming recession?
Um, I think it's going to soften well, not even think. It absolutely has softened the blow to banks in that they've been able to stabilize deposits. They've been able to, and also replace deposits with this BTFP program, Bank Term Funding Program, which is an extraordinary, unbelievable, never seen in the history of man lending facility. I don't think that's what people realize. So BTFP, we call it a mnemonic. So we've had extraordinary efforts from, well, for a long time, but particularly from '08. There was all these programs, all these things. What was it? Clunkers for cash, or what? All these different things, where it is supplying funding. But there was nothing like the BTFP where you get to, hey, all right, you're short on money, great, come to us, you can borrow the money, and you're going to have to pay for it, but it's better than any other rate you can get. The terms are extraordinary, better than any other terms you can get. Um, it saved a lot of banks, I bet. I know, and I don't think it's ever going to go away. I think it's going to be there permanently. It may actually, could be reasons it can go to zero, but I think banks are going to always have that as a backstop. If they're short money, if they need the money, instead of being forced to sell securities, they can just lend it to the Fed, or lend securities to the Fed and borrow that money. Boy, that's a big volatile event that they've just taken off the plate. Um, and I mean, look, just look at the graph itself. You go from 0 to 100 in 1 month. Because of the bank failures, and this is amazing. And I'll give you a number I always say on Twitter, and anybody who'll listen. If you read when Genius failed, which is about long-term capital management failing, forget what year it was, like '98 or something. You know, that was an absolute extraordinary event where Greenspan organized all the Wall Street banks to come together and come up with some money to bail out LTCM. Because if they didn't, they said it was all going to be Armageddon, financial Armageddon around the whole planet. It was basically I think Russia just said, we're not going to pay our loans. So, and on our bonds. So that just blew LTCM up. Point being is that number was about 3.5 billion. That's the number they had to come up with. Now, I know we've had a lot of inflation, but we've gone from billions to trillions in those short period of times. We treat trillions now just like we treated billions then. Like, not even, I don't even want to say that. Billions back then was like, holy crap, 3 billion. That was the bailout. Oh my God, it was just so cataclysmic. It was a huge story. They wrote books about it, da da da. And now we throw trillions around, like we're just like, BTFP now is probably itself is a little over 100 billion.
What's a
Just
few
nobody even
hundred billion
reports on.
between friends anyway?
Yeah,
It's
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 just
it's
like
it's peanuts.
nobody's, like even all this, oh, we're going to try to give 400 billion in student loans, and it's like, well, why not? We should do that. Nobody thinks 400 billion. I mean, somebody owns that stuff. It's mostly government, but I mean, that'll have ramifications too. So it's we just throw these numbers around. Nobody realizes how extraordinary they are.
Absolutely. No one realizes how extraordinary they are. And it seems to me that I think your take on BTFP being a permanent facility is right. We've seen that every sort of temporary facility that's been put up by the Fed over the last many decades, um, the lion's share of them, the ones that have become important, have just stayed and become permanent. And I think that this will be that because they've basically what the Fed has done here is they've essentially eliminated that huge tail risk of
Yeah.
banks having to sell these U.S. Treasuries, which would lead to this horrible loop,
Right.
kind of like we saw in the UK with the pension funds that threaten their solvency. The Fed has basically created a facility that's eliminated that tail risk. So why get rid of it?
This program would have saved Silicon Valley. I don't think they would have had a run. The reason they had a run is because Goldman, by the way, doing the right thing, doing the prudent thing, took a loss on their AFS portfolio of $2 billion, which, by the way,
And for the viewers, that's available for sale.
yes, available for sale. Their portfolio was actually quite conservative. Everybody's like, oh, they bought bad bonds. Certain financial media pundits that like, oh, they bought bad bonds. It drives me insane. No, they did not.
Mhm.
They bought the same bonds everybody else is buying. They bought, they're all U.S. government for the most part, all U.S. government backed, agency backed. No, they actually, and oh, they went too long in duration. Nope, they actually had a short duration. Their bonds were not that long. They were doing a prudent thing, but when they took the loss, uneducated depositors panicked and said, oh my God, they got these losses because the public doesn't really know that all banks have losses. The same time, 3, 4 years ago, for 15 years, all banks had massive profits, unrecognized, but they were still sitting, at gains. So had the BTFP existed, Goldman would have instead taken that collateral and borrowed it from the Fed at these awesome rates, awesome conditions, and they probably would have been fine, I think. And so
Hmm.
there is a level of what you said, a tail risk. They just removed this tail risk. Now, I will say this. Let me plant this seed. Is but what if you don't have any securities that the Fed will take, the BTFP? They'll only take you basically U.S. Treasuries and agencies. Okay. Well, you got PacWest and Western Alliance. They've been selling loans the last quarter. Okay. That's how they've been raising money. And I still don't know. I haven't really looked at their quarterlies yet close enough. I don't know if they're telling us what kind of losses, because I'm telling you, they're absolutely taking losses on those loans. And as a percent of principal, probably more so than what Silicon Valley took on their AFS portfolio, the bond portfolio. So there's a lot of little maturations here where it's changing the landscape of banking forever. Because now, if I were a bank, I got to make sure I've got some quality securities on my books. So in case I need to borrow from this program, I have that collateral. Well, what's that mean? That means I'm putting more of my money into securities and I'm lending less. Okay. So there is one ramification from all this of dozens that are going to be contracting from credit. going forward. And let me tell you, it's going to last a long time. And let me tell you, the Fed has no idea what that's going to look like a year from now, 5 years from now, 10 years from now. But it's here to stay for a really long time.
Absolutely. Fully agree with you there. I'll dive into this chart here, but we'll talk about in just a moment after we run through this. This is a bit more out there. I want to get your take after I phrase and explain it a little bit. It brings up a good question, which is if the Fed, the BTFP is only accepting U.S. Treasuries, then what of all of the losses on commercial real estate loans, and what of all the losses on commercial mortgage-backed securities that people are holding? Right? You mentioned PacWest having to sell loans. Well, eventually, what if that gets so systemic that the Fed has to now buy those loans, right? And then how many do they buy? And then do they
Possible.
make a new facility for that? And so it's
Hmm.
this big question of the Fed has now set the precedent that even though their government securities are the highest quality, they will buy distressed assets to save financial institutions. And I think that as credit stress continues proliferating, we're going to, the Fed's mettle is going to be tested about, whether or not they're really serious about buying distressed assets, and they may have to expand it to other things too. Um, I have a I want to talk to you about this really briefly. It's just mapping the BTFP rate and the SP 500. So the obviously the rate that loans are from the BTFP facility. As usage of that facility rises, then this interest rate rises. It's also kind of moved in lockstep with the S&P 500. It's diverged a little bit as of recently. Of course, there is no direct connection between these two. It's not as if banks are posting their treasury collateral and then going and immediately buying shares of the S&P 500. But it's an interesting chart because I think that the way Michael Howell phrased it to me last week, I had him on the show, was that essentially BTFP is allowing banks to extend their risk taking out beyond what would have normally happened to them. They would sell these treasuries, then hunker down and de-risk. Whereas now they're getting par back on these devalued treasuries, and the risk taking, is allowed to proliferate, and that's visible in things like the S&P 500. Do you lend credence to that at all?
Not a bit. I think
Mm,
I think these is a coincident movement right here and has no correlation whatsoever. The BTFP is survival. It's not,
mm,
oh, I could take more risk. It's absolute survival. Um, there is some arbitrage going on where, like right now, if I can borrow for a year at 543 and I can invest in a callable agency at 6% and make that spread, they'll do that. There's no risk there. That's a risk-free arb trade. There is some of that going on, but as it relates to the stock market, of course, I'm not a stock guy either. I'm strictly a bond guy. So I don't think there's any correlation there whatsoever. But I will say this: if you now that you bring stocks up, this is the only thing I can really, well, I could say two things about stocks. One is if you read Bernanke's essays on a Great Depression, and you even read his biography, the Courage to Act, which is a title of hubris like I've never seen before, he he talks about the stock market a lot. And to the point from the essays on the Great Depression is my opinion from what I got from the book is the stock market has to be managed. It cannot be allowed to crash. Because if you give
mm,
that visual to all the people in this country and into these little towns all over this country, all they're going to look at is see that and be depressed. And they're going to be like, golly, things must be bad. I better hunker down, which makes things even worse. The thing I keep talking about on Twitter, I've said many, many times, I wouldn't, I would love to see this. Love's not the right word. I would be interested to see some limit down days where stocks trade down so viciously that they shut the market down for periods of time to try to get people to calm down. I like to see the Feds face that and continue with their aggressive rate hikes and their aggressive policy. They haven't been challenged like that since when the first time Powell went in there with all guns ablazing when he became chairman, going, "Oh no, set path. We're going to raise rates. Not even going to talk about it. We're not even talking about ending rate hikes." All of a sudden, you got a bunch of limit down days for 2 or 3 weeks, and bam, cut rates, cut rates, cut rates, cut rates, cut rates. So that is my opinion is they can whistle past a graveyard because the stock market is supporting them by not trading off. Okay. I really truly believe that. And Well, we'll see what happens. We'll see if the market ever corrects and what their reaction to that is. The other thing I would do is a little off topic, but very quickly, go read everything Mike Green has written on passive investing. Mike Green, his Twitter is at Prof99, at PROF99. Dig into this guy. Go find the things he's written about passive investing, which is basically just indiscriminate. You put a dollar in a mutual fund, it gets dispersed by market cap. End of story. No thinking, no thought. How that's, he believes, becomes so dominant that the market has to keep going up on the whole until that flow reverses, and then that's when it gets scary. So to me, these are the things affecting the stock market: is this passive investing, and if it all starts to go south, the Fed will come in and save the day and buy, the Fed put all over again.
Absolutely, managing the stock market certainly is one of the Fed's not explicitly stated tenets. Of course, it is two, but there are many more, and the stock market certainly is one of them. Let's talk
It
about this
is. It
chart
really
here. You
is.
mentioned that a lot of the pundits who were criticizing Silicon Valley Bank were saying that they were buying extremely risky securities. But taking a look at this chart here, it seems like there's a lot of blood happening in U.S. Treasuries. This is gains and losses on Treasuries. Some of it is realized, some of it isn't. But when we're talking about losses on securities, we're not just talking about the risky stuff. We're talking about pristine collateral. So
Yeah.
talk to us about this here.
This is a great chart, actually. So if you go and you put, you go look at the beginning of 2020, right? So what you're telling me is banks are the greatest investors of all time. They bought such awesome bonds that they have a 1 trillion profit. Okay. If you're going to tell me they're dumb for having a 1 trillion loss, then you got to tell me they were a genius having a 1 trillion profit. All of that's BS. Okay. The reason they had a 1 trillion profit is because the Fed took rates to zero. And if you've got a bond at whatever percent, let's say it's 3%, and rates are at 3%, your bond is worth par. Okay. That's how it works. It's worth a dollar for a dollar. If rates go to zero, or let's just say 50 basis points, now I've got a bond that's yielding 3% and new bonds are yielding 0.5%. If you want to buy my bond, you're not going to buy it for a dollar. You're going to buy it for $1.05, $1.10, $1.20, 25. That makes up that premium you have to pay me, brings the overall yield back down to 0.5%. There was no genius moves back then either. They weren't. And if a bank came to me and had these, all my accounts had these amazing profits. What does that mean? Let me say that again. Amazing gains doesn't mean anything. It just means that, yeah, we're going to get a certain amount of cash flow come back. Every dollar that comes back, unfortunately, it's going to have to be reinvested at a lower rate, because that means rates are lower. That's the only reason I got those gains. Okay. So now we reverse, rates are way up, and now the unrealized losses on these portfolios are huge. Everybody's like, oh my God, it's terrible. No, absolutely not, unless you have to sell. Unless you have a run on a bank and you don't, and have to sell, you got no problem. Actually, it's a fantastic problem to have, because it means rates are higher, and it means every dollar that you have come in from your securities portfolio or from your loan book gets reinvested at these new higher rates. This is actually what a bank wants. Not the severity, not in this inverted curve, but it's almost as if for the future, if you could say my securities portfolio or my bond portfolio will permanently have an unrealized loss going forward for the next 10 years, that's actually awesome, because that means every time I get a dollar back, I reinvest it at a higher rate, which means my income goes higher. And that means my income goes higher and higher and higher, which means my capital goes higher and higher and higher, and my shareholders make more and more money. So that's why, the only time this is a problem, your chart's a problem, is if I'm put in a position where I have to sell those bonds or I have to sell those loans. Yes, we got a problem. Otherwise, banks just need time and they will heal.
Fantastic. So with BTFP, banks need to sell this. So even though it's a very scary looking chart, doesn't necessarily matter. because banks don't need to sell. They can just bring
No,
it to the
so
Fed.
all the red evaporates. So those are those
Mm.
unrealized losses. Normally, if I'm going to borrow from the discount window, I have to borrow at what the value of the security is. So if it's only pricing at 90 cents, that's all I can borrow from the Fed. And there's a haircut on top of that. So that's all I can get. The BTFP says, hey, you can borrow at par. So that's essentially zero gain or loss. You get your full par amount and there's no haircut. And if the rate goes lower tomorrow, you can lower your rate. So that the BTFP is really it saved the day for I think probably a lot of banks. And I don't know if you're going to show it now or not. I don't know if I forget what other graphs you have, but the banks right now are kind of same thing. And you're at the four big U.S. banks. I mean, you know, they don't care about this either. They know this is all going to go away. Bonds mature. All of that loss goes to zero with time. Bonds move towards par. If I own a bond and it priced at 80 cents, when it matures, I get 100 cents. If I own a bond at 120, that's how much it's worth, 120. If it's valued at 120 and it matures, I get 100 back. I get $1 back. So gains disappear, losses disappear. That's just how bonds work, and they always have been.
Fantastic. Okay. So I have when we talk about the Fed impairing a lot of financial institutions, U.S. Treasuries are obviously something that they've been able to ameliorate with this financial engineering with
Mm-hmm.
BTFP, bringing those unrealized losses to zero, staving off that fire sale of those assets. But there are a few big areas where those losses are still accruing per se as these rates are elevated and these rate hikes move through the markets and eventually move into corporates, move to consumers. The first chart here that I want to show is distressed corporate debt. So right now, this is ballooned up to $590 billion. And for the viewers, distressed corporate debt just means either bonds that are trading at a 1,000 basis point spread or higher, and the loans that are trading at 80 cents or lower. And that's considered distressed. So Randy, as we look at this and as the Fed is slated to hike once more by 25 basis points on Wednesday, given that we're now approaching 18 months since the Fed's first rate hike, what are your thoughts on the outlook for corporate credit markets as this distressed debt bubble continues piling up?
So again, credit is not my area, but but I can on a macro level, I can certainly speak to it. So you've got rates at essentially zero for 15 years. You put that on steroids because of COVID in 20 and 21, and you crush spreads, you buy mortgages, you take the benefit out of those. So not only are borrowers able to refi at the lowest rates ever, investors have to go to stuff like this to get any sort of yield because they're not getting it anywhere else. So everything's awesome for all these years, particularly in 2021. Now you reverse the whole thing on everybody. How could you not have problems? So all these borrowers are going to have to refinance this debt. They're not, very few of these corporate borrowers are borrowing bonds and then just paying them off and we don't need the money anymore. No, they're going to refinance the debt. If not, they're going to want to grow the debt because hey, if we have more debt, we can get bigger and bigger and bigger. So we need more and more debt. Now, to look at this and particularly look at real estate, rates are now 500 basis points higher, spreads are probably higher, so take that to 750 basis points higher, whole new ball game. I have all this infrastructure that I've you got to take, when you borrow money, you got to create cash flows that help you pay down that debt, or at least pay the interest payments. Well, all of a sudden my interest payments are going to go so much higher, they're going to double, triple, quadruple. If my infrastructure of what I invested in, is that stuff really bringing me multitudes more cash flow back than they did 2, 3, 4 years ago? I don't think so. Which means how are they going to fund these debt payments, and how are they going to refi these debt payments when credit is in contraction? Less banks are willing to lend. So yeah, you're going to have a problem. These guys are either going to have to come up with the equity to pay these loans down, or you're going to see failures. I don't know. You got to see failures. I don't. There's no other way.
Absolutely. It's beginning to seem like there is no other way, 100%. So we talked about commercial real estate, and I think
Hmm.
we got plenty of time here. We'll talk about this for as long as we need to, because obviously this is a pretty big can of worms. Plenty of distressed commercial real estate out there. Several numbers we can go to. There was a tweet that you put out a few days ago, actually 2 weeks ago now. It says extend and pretend,
Hmm.
cross your fingers. And the
Yeah.
extend and pretend situation has been getting increasingly prevalent. I believe I read somewhere that as of April, 30% of US office debt that was set to mature was extended either to later in the year or to the following year. And so it seems like from certain stats, which may be pretty conservative, that signal there's roughly 20% vacancy in U.S. metro office space. It seems like that distress is these commercial real estate mortgages are beginning to be really distressed. And the chart that I have up here for the viewers is one of small banks and large banks. Who writes more commercial real estate loans? And
Hmm.
you'll note that in the
Hmm.
red, small banks, those regionals, they make up the lion's share of commercial real estate loans, some $1.9 trillion outstanding CRE loans compared to large banks at $0.8 trillion. Randy, what are your thoughts here on the pretty messy commercial real estate situation? Seems to only be getting worse.
It's gonna get worse. I think we're just in the first inning. Maybe we're on this third pitch. We got a lot more to go, and that was the whole point. And I would, you won't get it all. I would tell everybody to go read that release from the Fed. It was actually from the Fed, the FDIC, the OCC, and the NCUA, which actually a joint release like that. I said this morning. uh, I replied to Chris Whalen had a tweet about this because the Wall Street Journal put out an article about this directive from these agencies to say essentially, hey, right now you need to extend these loans for a year. We know you're having problems. We know they're having problems. So do us a solid, extend it. We'll do you a solid, and we're going to look the other way. Then they give parameters. They don't want you to get too carried away, but I'll give you one is, hey, here's a good example. um, you did that loan at a 75% LTV, loan to value, which means as a bank, I'm going to try to make sure there's plenty of value in that building, in addition to what the money I'm giving you, that if you fail and you give me the loan, the building back, I can sell it and at least make my money back, and if not more. That's 75% LTV. We should all be familiar with your if you bought a home or anything. Well, they gave one example, and they say you can go up to say 102% LTV, because that means even the value of the building has come down, and even though the outstanding loan is 102% more, go ahead and extend it, and let's see what happens over the next year, and they can get whatever they magically things will get better somehow. And then they give a lot of other examples where they're going to look the other way, and so that is going to forestall reality, because if these guys are not forced to sell or basically realize the value of the building, then we don't know the value of the building. We don't know really what the pricing is. Um, that a really, really, I forget his Twitter handle, but John Tewig he trades loans for Raymond James. He sees all this all day long, and he's on Twitter. I think it's RJ Whole Loans, at RJ Whole Loans, I think. Um, he calls it trophies and trash is the only thing that's trading right now. Trophies are the most outstanding buildings in a city. Even though everything's going to hell, these buildings are amazing. They're new. People want them, and they're willing to trade them. And they're willing to buy them at really great rates. Perfect. Trash, we're just giving up. We're out. You see this, some of these guys are just turning the keys back in. And if a lender gets a building back, they want that off their books as fast as possible. And they're just going to take the lick and get the hell out of there. Those are only things really trading, and those are very slim. The mass volume of buildings, nothing's happening. I got a buddy of mine, he does commercial real estate in Nashville. He hasn't done a deal in like 2.5, 3 years. I mean, that's how dead it is. And we don't know reality. And that's what that directive from the Fed did. is it's extending reality a little bit further. So hopefully, in my mind, I think the Fed's like, yeah, we're going to be cutting rates inside a year. So once we start cutting rates, all of this will start correcting a little bit. Now, that's for all commercial loans. Offices are dead. I don't know how somebody's. I don't know how that recovers. There's 20 people in my building that hold 4, 5, 600 or something like that, maybe even 2,000. It's crazy in Nashville. I'm going to be very curious to see what happens with our building, but it is virtually empty, and they still are holding on. I don't know. I don't know for how long, but we'll see.
Absolutely, we will see. Office space is certainly facing an uphill battle, and I tend to think that it's going to come back to the lenders, and it's going to come down to what the Fed is willing to do. Clearly, with Treasuries, they've been able to save them, but what are
Well,
your thoughts on what the
you
Fed
said
does
something
here?
earlier. They didn't make unrealized losses go away. They just made them irrelevant. Okay, for
Mm.
if they made them so you don't have to recognize it. Okay, because if they didn't have that, and if a bank couldn't get a loan, it couldn't find, and they had to sell, okay, the unrealized loss now becomes realized, and it's very real. The Fed just eliminated uh, greatly your need to recognize those unrealized losses. So that's good, and that it's a big bailout of sorts, but it probably is a really good. I think it is a good thing. Commercial real estate is going to be a whole different ball game. There are going to be realized losses here. It's going to impact these regional banks because, as you show here, they're the primary driver of those kinds of loans. They should be because these are mostly community banks, and most of the loans are community buildings and community institutions. Um, but let me explain one last thing here. I mean, I can stand forever, but I know you want to cut this soon. The problem, and I see this on Twitter a lot, the problem is not the refinancing rate. That is a problem. Okay. I got a loan of 4.5, and now you're telling me it's 8.5. That's a problem. Okay. In itself. But there is a much, 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 much worse problem. If I have a building, okay, it's this basically called a cap rate. It's what we use. I get cash flow from this building. That tells me how much I can ultimately lend you on a building. So if I lent you a 5% cap rate 2, 3, 4, 5 years ago, and the valued the building based on the cash flow at $2 million, and I can give you thus, I say, 70% LTV, here's 1.4 million at 4.5% with your building valued at 2 million, right? You come to me now. Hey, it's at 8.5%. Cap rate's actually 10%. What's that mean? Well, have you increased your cash flow in that building? Not really. It's all office rentals, a little bit, not much. Great. That means the building is now worth $1 million. And by the way, I can't lend you 70% LTV, which would allow me to give you 700,000. I can only lend you at 50% LTV, so I can only give you 500,000. And you did a IO, interest only loan. You really didn't pay off any principal during that time. So you still owe 1.4 million on this loan with this building as collateral that is now only worth, a million, and I can only give you 500,000. So you got to come to the table with 900,000 equity in order to refi only 500,000. I hope that makes sense to people. That's the problem is I can't get enough money to even at current rates to repay the loan. That's the tragedy here. And that's what hasn't hit the books yet. That's what we're not realizing yet. That's what the Fed and the OCC and the FDIC and the NCUA just tried to put off into the future is, okay, let's see if we can give this guy another year, and hopefully something happens in that year where this problem goes away. That's what people need to realize. That's the horrible thing here is, oh my God, I can't get the money at all.
Absolutely, definitely, extremely disconcerting. And one last thing before we go, somewhat facetious, somewhat not really. This is the current state of office to residential conversions. Randy, do you think that this is the strategy we'll see to help bring the housing market back into supply and
This is
demand back into supply with one another? Is this
if
the
you talk
future?
to if you talk to a commercial real estate realtor broker, that's exactly what they're going to tell you. Oh, here's what's going to happen. That's total BS. It's not. um, the numbers just don't work. It's not going to work that way. These buildings aren't meant to be like this. I mean, yeah, are there going to be examples? Sure. Is it a panacea? Absolutely not. There's no freaking way. I mean, my building in Nashville, they were planning. I don't actually know why the loan blew up, but the loan, it just had sold several months ago. They were going to make it all medical offices. So that was the idea. They're going to put a restaurant in, and then going to have all these different medical offices, anywhere from dental to MRIs and whatever. And for whatever reason, the loan just fell through, didn't come through, and they're back to square one, trying to get rid of that building that doesn't have any tenants. And so, no, I don't think there's a panacea at all.
Fantastic. Well, Randy, it's been fantastic. I've wanted to do this for quite some time, and I think that the viewers got a great deal of value out of this episode. We covered a great deal. Any closing thoughts, any parting thoughts on fixed income, the Fed, markets, the path
Yeah,
forward over the next many months?
I'm going to do a plug for not even really a friend, but I want to tell you something. I'm so hyped about this book. So this is Andy is a guy at the BBC that has studied and reported on LIBOR uh, back from the begin from '07, once it started to become. This book just came out called Rigged, and basically what he's going to explain in here, and I've talked to him a little bit about it, and LIBOR, when I went to Bloomberg in '88, that was the first thing I was taught. Okay, the first thing you got to know is what LIBOR is, because it's so important. And for you too, Joe, it's something you should read. And I think you should get Andy on this podcast. Is he is explaining basically everything that happened in '08, '09, and 10 with LIBOR was there was no rigging. What was rigged is we had to have scapegoats because we want to kill LIBOR. This is the central banks. We're going to kill LIBOR because we have to control this short rate, not the market. And up until
Mhm.
'08, the market controlled LIBOR, and then the Fed took it over, the central banks took it over, and then they had to have scapegoats to go, oh, see, well, we had to take it over because they were rigging it and they were making huge profits and da da da. It was all BS. That's going to be a really exciting book. If you're into the Fed, if you're into financial markets, this is the kind of book that really is going to give you a deep look into how violently these central banks want to control financial markets. And I think everyone's going to learn a lot from it. And once I finish it reading, I'm hopefully going to get Andy, and I would, get him on as many podcasts as I can, because you guys need to know the story. There's a lot of people who weren't even, probably you, weren't even in this market at all in '08. And
I was six. I was 6 or 7. Yeah.
yeah, there you go. Okay, no, that's so depressing for me to hear, but it's it's such a story worthy of your attention. I highly recommend that. And I forget Andy Verity. He's on Twitter, Verity. Get after it, man. It's a hell of a story. And listen, LIBOR's not they're killing it, but there are ramifications already coming, and you watch. It's going to continue to be a topic.
Fantastic. Randy, thanks so much. You heard the man. Go check out Rigged by Andy Verity. You can find the link for that Amazon book in the description. You can get it on Audible as well. Go read that book, and we'll get Andy on the show because
You
the
should.
transition to SOFR, and I love the whole
Let me
idea
co-host
that it
with you.
was.
If you do it, let me co-host with you, because I'll know I know what to point to, and from my experience in '06, '07, and '08 particularly, I know what they did, and boy, he's got a great story.
Fantastic. We'll do it. I love it. All right. So, Randy, thanks again for coming on the show. Before we log off here, where can people find you?
Well, I'm on Twitter at the Bond Freak, which very quick I just got that from Nicolas Cage, and what was that movie he did out there with the Ellis Island, or not Ellis Island, the oh God, I forget the name, but basically he saves the world with the nuclear bomb in San Francisco. There's a scene, the guy goes, "Oh, so you're the chemical freak?" He goes, "Well, no, I'm the chemical super freak, actually." And when I got my Twitter account, I couldn't do Super Bond Freak, so I couldn't do Bond Super Freak. I had to use it shorter. But anyway,
Mhm.
that's it. I don't sell anything. I don't have anything to sell. I like educating, and I had a lot of people in my career that took a lot of effort to educate me, that made me so much better at what I do. I just love doing it, and I learn a lot from all of you. So that's it.
Of course, absolutely. One of the best follows in the space. If you have Twitter, or you don't have Twitter, I'd highly suggest following Randy. A great mentor. Great to take a look at the timeline and learn from him. And of course, thank you so much for tuning in today at the Bitcoin Layer. You can subscribe and hit the notification bell so you don't forget when we upload. You can also check us out on Fountain. It's a direct to listener podcast app where you can pay us in Satoshis, and you can have all that Bitcoin functionality with you there. But that's it for today's show. Randy, once again, thanks for coming on, and we'll talk to you later.
Thanks, Joe. Appreciate it.
Special thanks to River for sponsoring this channel. Purchase Bitcoin with zero fees when you dollar cost average, and know your assets are held in multi-sig cold storage with 100% full reserves. Not letting it out to anybody. You'll have peace of mind. Plus, River has their own built-in infrastructure, so they don't rely on third-party custodians. It's all in-house. There's a new standard in Bitcoin, and River is setting it. Get started at River by visiting river.com or by clicking the link in the video description.